Hey everyone, we need to talk about what just happened in the silver market. Silver crashed from 116 down to 79.92. That's a 38% collapse in 2 days. If you're holding silver, every 100 ounces you own just lost $38,000. Gold didn't escape either. Down to 46.62 today, nearly 15% gone from recent peaks. But here's what mainstream media isn't telling you. This was the worst 2-day drop in precious metals since 1980, triggered by margin hikes, forced liquidations, and a leverage bomb that just detonated. Here's what this means for your money right now. If you held a standard allocation with 20% in precious metals on a $250,000 portfolio, you just lost between $7,000 and $12,000 in 48 hours. But here's the part that should terrify you or excite you. In Australia right now, physical silver coins are selling for $150, while the paper price sits at $79. That's a $71 difference, a 60% premium between futures and actual metal. Something bigger is happening beneath the surface. Here are the 3 factors that converged today. First, on Friday, CME Group raised margin requirements. Gold margins went from 6% to 8%. Silver jumped from 11% to 15%. That's a 36% increase in capital required to hold positions. Traders who couldn't meet the margin call got liquidated automatically. Silver dropped from 85.15 Friday morning to 76.78 by close. Over $8 gone in one session. The cascade continued today, hitting a low of 71.36. Second, this morning around 10:30 Eastern, over 43,000 silver contracts traded in 20 minutes. That's 215 million ounces dumped onto the market. This wasn't gradual selling, this was algorithmic liquidation. When prices fall, automated systems trigger more selling, which triggers more margin calls, which forces more selling. It's a death spiral for anyone using leverage. Third, the dollar index rallied from 95.36 last week to 97.15 today. When the dollar strengthens, commodities priced in dollars fall. But this wasn't economic strength. This was forced unwinding of positions. Silver longs got margin called, dollar shorts got squeezed. Both markets experienced technical breakdowns simultaneously. Now let me show you what smart money did while retail panicked. According to Reuters, precious metals ETFs received $4.39 billion in January. That's the 8th consecutive month of inflows. Institutions were accumulating. China's central bank bought gold for 14 straight months through December. They added over 27 tons in the final quarter. Poland increased holdings by 19 tons. Turkey added 33. These aren't speculators. These are sovereign nations building strategic reserves. But here's what today revealed. During silver's rally from 76 to 116, retail piled in. TD Ameritrade showed 74% bullish by January 20th. Meanwhile, commercial hedgers held their largest net short in 18 months. The big producers were selling to retail at 90, 100, 110. Then margin hikes flushed everyone out. Retail got slaughtered. The pros positioned short made fortunes. And while silver crashed 38% on paper, physical supply tightened. Australia dealers are charging $150 for coins when spot is $79.92. Delivery times stretch to 2 to 4 weeks. Physical buyers aren't panicking. They're stepping in. The crash is in paper contracts, not real demand. I pulled up the charts this morning. Silver broke below its 50-day moving average at 82.40. If this holds as resistance through Friday, a head and shoulders pattern completes, historically leading to another 10 to 15% decline. But if we reclaim 82.40, this was capitulation. The RSI dropped to 23, deeply oversold. Last time we saw these levels was March 2020, right before silver doubled from $14 to $29 in 4 months. Trading volume was massive, over 215 million ounces on COMEX this morning. These were real sellers taking actual losses, not low liquidity panic. Now the fundamentals. Global silver demand hit 1.2 billion ounces in 2025, up 7%. Solar panels consumed 190 million ounces. EVs required 85 million. Industrial applications took 420 million. Mine production, 830 million ounces. That's a deficit of 370 million ounces annually. Here's the critical part. 70% of silver comes as a byproduct of copper, lead, and zinc mining. When those operations slow, silver supply gets squeezed. COMEX registered inventories have fallen 70% since 2020. 117 million ounces withdrawn since September alone. That's 22% in 4 months. We've seen this before. In 1979, the Hunt brothers from Texas accumulated over 200 million ounces trying to corner the market. Silver rallied from $6 to $50 by January 1980, 730% in 12 months. Then on January 21st, COMEX raised margins with Silver Rule 7. The Hunts couldn't meet margin calls. Silver crashed from $50 to $11, 80% collapse. Silver Thursday, March 27, 1980, nearly destroyed banks. Compare that to today. We rallied from $28 in October 2024 to $116 in January. Over 300%. CME raised margins Friday. Silver dropped to 79, 38% so far. Same mechanism. But here's the key difference. In 1980, there was no deficit. Production exceeded demand. Today, we have a 370 million ounce annual shortage. Silver is consumed in solar, EVs, 5G. It's gone forever, not sitting in vaults. The hunts were pure speculators. Today's rally was driven by real industrial demand and inflation hedging. Based on 1980 timing, it took 6 weeks from margin hike to final low. That puts us between mid-February and late March for a bottom. The hunts saw 80% declines. I don't think we go that low because fundamentals are different. Conservative estimate, another 20 to 30% down, putting silver between $55 and $65. Let me make this personal. If you bought 500 ounces at an average of $32, you spent $15,900. At the 116 peak, you had $58,000, over $42,000 in gains. Today at $79.92, you're at $39,960. Still up $24,000, but you watched $18,000 evaporate in 2 days. If you bought late, say 200 ounces at 110, you spent $22,000. Today, that's worth $15,984. You lost $6,016, over a quarter of your capital. But try selling physical today. Dealers offer 75 to 77, not 79.92. Want to buy? They're charging 90 to 120, some up to 150. The bid-ask spread exploded. China started accumulating at $28 silver back in November 2024. They didn't wait for confirmation. Mining companies locked in forward sales at 95 to 105 in December. Now spot is 79, but they're receiving 100 from hedges. They see the real supply picture. The question isn't whether we see more volatility. We're in a forced liquidation comparable to 1980. The real question is, are you positioned for what comes next? In 2008, 2011, March 2020, hard assets preserved value after the initial flush. Right now, silver sits at $79.92. The next 2 weeks determine if this was the low or just the beginning. I share real-time updates on social media when critical levels break. For in-depth research on margin changes and positioning data, there's a premium level. This is educational content, not financial advice. Do your own research. Consult licensed financial advisors before making investment decisions. These are market observations and analytical frameworks, not buy or sell recommendations. But the data speaks for itself. 60% physical premiums. Inventories down 70%. And we're comparing this to 1980 when the full collapse took 3 months. All right, 3 quick things. 1. Comment below where you're watching from and your prediction. Where's silver headed by end of February? $60 or back to 90? 2. If you're not subscribed, hit that button. I'm putting out daily analysis as this develops. If this provided value, comment data over hype so the algorithm knows you're here for the original content. 3. Tomorrow's video covers the one indicator that predicted both 2008 and 2011 crashes. It's flashing again, and last time silver dropped another 40% within 6 weeks. See you there.